Well, it's in an all-time low, and sometimes people talk about a bad vibes economy where it's just a bunch of Gen Zers on TikTok complaining about the economy. But the real issue is that young people are living in their parents' basement, and you can only be so optimistic about what's happening in the larger economy if you yourself can't afford to start a family, to move out on your own, to own your own home. That's the American dream, and Americans are just obsessed with this idea that our well-being, our sense of having arrived economically depends on our ability to buy a house. And right now, that dream is sort of stillborn for Americans in the millennial generation and younger. Those folks are just coming of home buying age. It's created a huge bulge in home buying demand, but no real increase in supply. Home prices have shot through the roof. And it used to be that you kind of had to win the lottery if you lived in San Francisco or New York, but in the rest of the country, you could have a working class job and still afford a home. But because remote work let people leave San Francisco and New York and still keep those high paying jobs, it's the rural parts of North America that have really seen home prices shoot through the roof. And so now that anxiety that we once saw concentrated in the big city is everywhere. And it means that you really have to do well to be able to afford a home. We've seen that parts of the country where home builders can more easily build homes because there's less regulation have had lower amounts of home price increases, which is great news. And in fact, in places like Texas and Florida, for the first time, we've seen some evidence of their having overbuilt. Prices have significantly softened. And as I said, that's unprecedented. I haven't talked about falling prices since 2010. So it's really been a long time coming that we are starting to get around it on affordability in a few key places in America that have been pro-development, where we've really been building a lot of houses. But in most of the country, there's still a shortage. And part of that is the country is so divided on whether we even want home prices to fall. Everybody's already got a home, has a panic attack if home prices fall, but the people who don't really want the government to do something about it. It's really hard to say because on one hand, you still have strong inflationary pressure, at least in the US, where hiring has been strong, corporate earnings have been strong. Retailers have talked about some softness in the market, but mostly the Fed, I think, has felt very careful about lowering rates. And there's also just the pressure that government debt creates on interest rates, where even if there's not inflationary pressure, just a larger proportion of dollars are going to the federal deficit. So all of that is long-term inflationary pressure, but there's also some indication that there's a weakening in the overall economy in the United States. So in the first quarter, it was just booming. The stock market was very high. Jobs were very strong. The service sector was very strong. But now the service sector has started to soften, and that's a major part of the U.S. economy. So there are really some mixed signals right now. I think people are feeling anxious about the economy and anxious about inflation. And usually those two work against each other. Usually when the economy starts to soften, inflation starts to ease and interest rates come down. But right now there's still some inflationary pressure and there's also some economic anxiety. So it's a little bit of lions, tigers, and bears. The most important variable right now is just the consumer price index. So that data comes out on the 15th of every month, and then the Fed responds to it a few weeks later. But within 30 seconds, the mortgage market, the mortgage-backed security market, has already priced in what they think the Fed is going to do based on that inflation print. So the date that is really important for mortgage rates here in the United States is just the 15th of every month, because right now we all know that the Fed isn't going to back off on its own, that it's going to have to see a significant indication that inflation is starting to ease. And so far, we haven't seen that. I think we were able to shake it off January, February, March, but then more inflation pressure came in April, and that's when the Fed just said, screw it. We don't think there's going to be a rate cut anytime soon, maybe one, maybe two in the very back half of the year. But that's when rates went back from the mid sixes, even low sixes, back up to above 7%. And that's really where they are right now. And what's been remarkable to us, because Redfin.com sort of tracks not just what people are doing on the web, but because we have our own agents, what they're doing when they tour houses and whether they write offers at the end of the weekend, is how minutely sensitive the American consumer is to rate increases. So I can tell you right now what kind of weekend we're going to have just based on whether rates came down Thursday or Friday. So people are watching it more closely than ever. I've never seen so many consumers who have become trained as economists to look at what's happening with inflation and interest rates to make their own personal decisions about when they're going to start a family or where to live. Vindication, baby. I think that's starting to happen right now. So
Okay.
we really saw in the first 3 or 4 months of the year new listings accelerate. Now there's just a large number of active listings. The only reason those two metrics are different is because active listings also accounts for the fact that homes have started not to sell, that they're sitting on the market. And so when homes sit on the market, you start to see prices soften. The parts of the United States that were the hottest, literally and in the market, Texas and Florida, now are seeing major price cuts, homes getting delisted because they can't sell. Almost every real estate broker is having conversations with home sellers about when you're going to mark this property down so we can get it to move. And real estate is just really sticky. It's not like other consumer products where a manufacturer is very rational about the pricing and immediately drops its price whenever it sees a lull in demand. Homeowners are emotionally committed to their property. They have in mind a number and they're loath to give it up. And so that makes home prices stickier. But still, I think it's going to be a pretty soft summer for home prices. Luxury is holding up a little bit better, but the middle of the market, which has actually been the hottest over the past 3 or 4 years, that's where home buying demand has significantly softened. I think right now that is definitely the case. Sometimes actually there's a higher beta on luxury properties. So typically, there has been a real shortage of starter homes in America, and that's been compounded by the fact that investors have been so active in competing with first-time home buyers for that inventory, except now those investors who are using borrowed money have been squeezed by higher interest rates themselves. So we're seeing less speculation in the middle of the market, and the luxury market's holding up better. So actually, middle into the market, or the middle part of the market, not the end, that had been the hottest part of the market until about 6 months ago, and now that's significantly softened. And in general, investor activity is really starting to decline. And that had been a major change over the past 3 or 4 years, where you'd seen sort of this Wall Streetification of Main Street, where houses had become just another investable asset class. All these major funds were just steamrolling into, and now they're starting to recede and even put some of their inventory back into play. Well, some people can't hold because they've already been holding on for so long. So a lot of our customers are folks who got a divorce last year, and the husband and the wife are driving each other crazy. Or, they own a townhouse and they've had a third child and they're just bursting at the seams. So they put it off as long as they could. But housing is at the bottom of Maslow's hierarchy. It's a basic human need. And so at some point, even though people don't want to sell, they have to sell. And the big difference between the great financial crisis of 2008 and this massive housing correction of 2023 is pretty simple. We ripped the Band-Aid off in 2008. Lots of people didn't want to sell then, but there was a massive foreclosure crisis because loans were so low quality and employment went into the toilet. Here, it's kind of been a weird correctionless correction where, yes, home sales volume went way down, but prices didn't. And most people, rather than putting their home up for sale when there was very little demand, just held it off the market. And now they're starting to say, wow, I don't know when it's going to get better and I just have to move. Well, condos are always more volatile than houses. So, if the housing market catches a cold, it's almost like the condo market gets cancer or something. It's usually much, much worse. That's just the asset class that has a higher beta. So I would expect condos to struggle more. I don't think it's going to be some catastrophic price drop. What's been catastrophic has been the decline in home sales. So volume is lower than it ever has been before. It's lower than it was in 2008, but prices have held up mostly, and now they're only just beginning to soften. And the issue is that there aren't enough sellers, there aren't enough buyers. Both sides are affected by interest rates almost equally. The sellers don't want to sell because they want to hold on to their mortgage. The buyers don't want to buy because they simply can't afford a mortgage. So it's been a real jam in the U.S. housing market. And the only source of relief has been the builders, and they have been building like crazy. That's what's kind of broken the log jam and started to drive prices down, is that there's just excess new inventory. We have a huge backlog, even though the United States has been much more draconian about immigration and population growth is somewhat slowed. We are just millions of units shy. So we could talk about price declines as some kind of calamity, but let's just go back to the outset of the show where we said that affordability is the real calamity. So home prices need to come down by hundreds of thousands of dollars to meet working class people where they are. And the only way that can happen is if we continue to increase the supply. And so I see this correction in prices, modest as it is, as long overdue and absolutely welcome. And the same thing, I think, will be the case in Canada. Already I've seen, and we talked about this, I think, on the last episode of the show, that Canadians have a different attitude toward home prices, where they are much more aligned behind this idea that bringing home prices down and letting more people afford that home is just fantastic. And America needs to get that way too, because otherwise people are going to vote with their feet and they're going to keep going to Canada instead of to here. Maybe. I think you just have to realize that that cut is already priced into the mortgage market. So traders trade on future information. And so if there are two cuts, mortgage rates will go down. If there's only one cut, mortgage rates will maybe come down modestly, because it's still possible there won't even be one at all. But by the time the cut happens, the traders are already looking ahead to the next year and trying to factor in how the Fed is going to respond to inflation. So I think the real issue is, will there be several rounds of cuts in the first half of 2025? Because right now, I think there's a pretty strong consensus that maybe we'll get one cut, and we'll be lucky to get that. So if we get it, fine, rates come down a little bit. But I think before you see significant refinancing activity, you'd have to be somewhere in the low sixes. Just coming down 50 basis points would spur significant purchase activity, and one cut might be enough to do that. It's just a question of whether we can get a soft landing. If you can keep rates higher for longer and still have people feeling good about the economy, good about their job. Right now, maybe the other factor, I always sort of discount it, but you just hear it from too many home buyers, is the American election has become such an incredible spectacle that it almost suspends all major forms of economic activity, because we're just glued to our screens trying to figure out if it's going to be Biden or Trump. So that spectacle will probably lead many people to put off their home buying plans as we get toward the late summer. They're just going to say, maybe the economy is going to change based on the election. I'm going to put off this big decision until I see who's in the White House. I think that, people who are worried about losing their jobs definitely aren't going to buy a house. And at some level, you can talk about, well, what if rates came down? What if rates went up? Volatility itself is the enemy of people's long-term plans. And so the argument here is that if you're going to buy a house and own it over 10, 20, or 30 years, the challenge you're going to have is that you have to believe that the economy is basically going to be a stable system. And right now, because of the ups and downs and how violent they've been, some people are just saying, screw it. I want off this merry-go-round or whatever terrifying Disneyland ride this is. It's just been too bumpy for me.